Welcome to Yellow Tunnel. My name is Lark Harpel. I'm CEO and founder of Yellow Tunnel. And today I'd like to go over current market conditions, what to expect in terms of interest rates, in terms of dollar, in terms of main indexes. We're going to talk about call spreads and spreads in general, option spreads using for earnings. We have earnings every week. There's some earnings. Next notable earnings is Broadcom. The AI theme, artificial intelligence theme, especially chips has been very creating a lot of demand in terms of option traders. We've seen this with HPQ, Hewlett Packard. We've seen it with Dell. We've seen it with CRM in the past couple of weeks. So we'll see what the Broadcom earnings look like shortly, and how to take advantage of options trading. I'll try to make it informative, so it's not just option trader. Even if you're a stock trader and you don't know anything about options, I will try to show you how to find support and resistance, right? Looking at the gamma exposure, looking at the high open interest. So you can utilize options data even if you're not an options trader to kind of find these key levels that everybody will watch for. If you have any questions, please enter them inside of the chat. I'd like to maybe spend half an hour talking about the content and then open up and make sure that I have enough time to answer any questions you might have. If you're new to Yellow Tunnel, or if this is your first broadcast, welcome. Do me a favor, type in first. I do see a few new names that I haven't seen before, so welcome. Thank you for joining. This is my brief bio. I was Executive Vice President, Head of Technology at Options Express. The difference between Yellow Tunnel and maybe other newsletters or technology subscriptions that you have is that my background is technology, right? I have a master's degree in computer science. I was a CTO of several publicly traded financial companies specializing in trading, brokerages. Since one of them was Options Express. Once Options Express went public, I decided to manage my own money, build a team of financial engineers that are constantly building new models and finding opportunities in the market. So we have a team of financial engineers building models based on artificial intelligence, neural networks, and then every day, every week, the models run, give us signals to our team, and then I use these signals to trade in a live trading room environment. And you can see these trades in either in a live trading room environment, or if you sign up for a SMS message, or it's available as a subscription on the web, right? So you have real-time access to these orders in position, and that's kind of my experience. And the difference between Yellow Tunnel and maybe other subscriptions. Disclosures are very important. Please read them. If you're new to trading stock or options, I encourage you to visit optionsscreening.com to understand the risk associated with trading stock or options. I'm not a financial advisor. I'm not registered with FINRA nor CC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. All right, before we jump into trading psychology, let's talk about Broadcom. Let's talk about current market conditions. So let's look at aggressive power trader. So we have different models, right? And aggressive power trader basically showing you which stocks are trending higher. For Friday, it was AMAT, HPE, Procter & Gamble, DHR. For spiders, we still see a strong bullish uptrend in the next couple months, potentially reaching 548, 550 level. You see that momentum is slowing down, deteriorating behind the bulls, but it's still a pattern of higher highs and higher lows. I agree with the model. I think we could reach 550 in the next months or so, maybe in 2 months. And I think it will be a pattern of higher highs and higher lows, but it's not going to be a one-way trade. We will have pullbacks. You know, sometimes it's 5%, sometimes it's 2%, but shallow pullbacks, probably short-lived, and probably mainly triggered by macroeconomic conditions, especially until the next earnings season, which is in the middle of July. So we had CPI data. This week we have CPI data. We have unemployment data. right? And you can see that the spiders continue to make new highs. We broke briefly through this level 532 on the better than expected manufacturing data, on the interest rate cuts in Canada, right? In European Union, they already started cutting interest rates, and expectation that we're going to have a soft landing, right? So between manufacturing data and the interest rates did drop significantly. Let's look at the interest rates. Briefly broke through 50-day moving average and broke through 200-day moving average and broke through this uptrend, And now we have a pattern of lower highs and lower lows on the interest rates. And that's works well with the idea of the soft landing, right? That we're going to have a soft landing and we're not going to have a recession. On Friday, employment data did come in better than expected. I mean, it's kind of, the unemployment rate did tick up. You have a 4 handle, which we haven't had, I think, for a couple of years. So it's at 4.0. But the hourly wages, let's look at if it's still available on MarketWatch. June 10th, June 18th, June 6th, yeah. So unemployment rate, still very strong, creating new jobs, more than expected. Hourly wages did tick up, so people are making more money, and unemployment rate, I think, was 4.0. So as a result of that, interest rates were oversold, right? They were extremely oversold. We dropped from 4.65 to all the way to 430, and actually broke through the 430. That's an important level that we went over. We've been fighting for this level since August of 23. So for the past actually 2 years, August 23, and I think this was the high for the October of 23. So right now, market is very highly correlated to the interest rates. And if interest rates drop, market rallies. And if interest rates rise, then market pulls back, or at least losing momentum. So 4.3 is an important level. You can argue that we briefly broke below that level. Briefly broke below the level, but on Friday was the higher than expected wages and more job creations, potentially delaying the interest rate cuts, right? Even though it's already started in Canada and in Europe, but in the United States, still uncertainty, right? And you do have a pretty sharp rebound above 200-day moving average, still below 50-day moving average, still a pattern of, at this point, lower highs and lower lows, which I think is bullish for the market. In terms of next week, CPI data, right? The inflation data is the next kind of piece of information that will push the interest rates either higher if the inflation is going to come in, higher than expected, right? Higher for longer, or it will drop, right? Interest rates will drop if the inflation data is dropping, right? Trending lower, or at least comes with an expectation that the idea that Fed will follow European Union, follow Canada, will cut interest rates. So we could see rate again at 460, or we could see rate basically below 4.28. I think if it drops below 428, that would be bullish for the market. If it gets to 460, 470, I think that will be at least short-term bearish for the market. Meanwhile, you can see that QQQ breaking out, right? For 3 days, we were above the breakout level. That's usually bullish. We've been above 450 for now almost a month. So I think, again, even if we do have a pullback, it'll be short-lived, and you will have patterns of higher highs and higher lows. In terms of bearish arguments, small caps continue to underperform. You do have the below 50-day moving average. So in terms of how broad the rally is, it's still, at least for now, led by a few industrial names, by a few banks, and by mega cap technology stocks like NVIDIA, right? And Netflix of the world. But small caps, I think mid caps are struggling. right? Small caps are below 50-day moving average, mid caps are below 50-day moving average, and high yield, right? If you look at the high yield, it's kind of staying right at the 50-day moving average, but also a pattern of lower highs and potentially lower lows. So it's not, it's going to be a choppy market, right? It's going to be a choppy market. We're going to have rallies, you're going to have a pullbacks, but I still think it's a pattern of higher highs and higher lows. And outside of the value stock, outside of the technology stocks, value stocks in general, VTV, are above 50-day moving average. Dow Jones, I think, right below DIA, right at. So value stocks, high yield, are sitting at the 50-day moving average, which is, based on CPI data, either will push it back to the highs or will break to the 50-day moving average. So CPI, PPI data is important. So I usually go through these future rehearsal exercises, right? Why is this important? Where spiders are going or where interest rates are going, where you can just buy NVIDIA and it's gonna, continue to go on higher. Well, you need, because market stocks are correlated to ETFs, and right now indexes like QQQ and spiders are highly correlated to the interest rates. So let's go over these scenarios. One is that we're gonna trade above 520 level, right? Let's talk about going into the earnings season, middle of July, right? One is we're trading basically, kind of like I said, the 50-day moving average holds, right? And we're making a pattern of higher highs and higher lows going into July, right? That's scenario number one. 50-day moving average does hold, 520, 510 level. Scenario number two is we break through the 50-day moving average, maybe worse than expected CPI, PPI data, and we are back to, main support right now is 495, right? That's kind of the main support. So those, I think, are two scenarios. Maybe third scenario, we're just trading sideways, kind of this, which we've seen sometimes for months. So I think scenario one, higher highs, higher lows. Scenario two, we drop to 494. Scenario three, we're trading sideways, right? So one bullish, two bearish, three kind of sideways. Those are the three scenarios. Why are they important? Because that will dictate what strategies to utilize, right? If it's one, you'd buy calls, call spreads, or buy stock. If it's scenario number two, maybe you do cover calls, protect your stock position, or do mirrored puts, buy puts to protect your stocks. And if it's three, then you do market neutral strategies like butterfly condors, iron condors, something that where you long and short the market at the same time. If you're doing stock, then you would buy long stock and maybe you hedge it with inverse ETF. So let's think about scenario 1, 2, and 3. And if you guys can type 1, 2, and 3, that would be very helpful. And that will help you determine position size, right? Strategy and position size. How much money do you want to invest into these strategies based on your belief in where the market is heading? And while you guys doing that, just type in 1, 2, and 3 inside of the questions. George, Luis, Trond, J. Pieri. Luis, 3. Okay, sideways. Thank you for participating. George, Trond, Michael, Steve. Okay. So now I'm looking at the positioning, right? While you guys thinking about 1, 2, and 3, I'm looking at the positioning. So you have, let's look at the June expiration, and let's look at July expiration. Okay. So what you're looking at, I mean, you have a gamma exposure chart, you have beta exposure. I mean, these are options data, right? Second derivatives. You know, I'm not going to try to spend too much time explaining what those second derivatives are, right? It's a change of the delta, which is the first derivative, versus stock price, versus volatility, versus time. But what's important are these high bars, right? Spikes. So right now in July, there's 75,000, so a lot more positioning. People are buying 500 puts, right? So what's important is the strike price, right? The level. So if you're, even if you're a stock trader and you're not an option trader, you can see that the April, May lows, the 495, 500 right now is well positioned. And, you know, unless there is some kind of a new event, this level probably will not be broken, right? And this is going into the earnings season, July 19th. If you take out the July 19th level, what's well positioned, a lot less, but you have 520 level, right? So we're trading at 534. People are buying 520 puts, 35,000 of 520 puts, and 35,000 of, and this is, you know, VANA. But there's very high open, relatively, not very, but relatively high interest at 520 and 510. So those are the two levels to watch as positioning. And in terms of overhead resistance, you have 545, right? So probably going into June expiration, which is in 2 weeks, and let's go into July. July, the high positioning is 550. So probably going into the expiration week of June and then July, best case scenario, we're at 550, right? So 3% to the upside, we're at 550. And that will be dictated by CPI data, PPI data, you know, Fed decision in terms of interest rates. And on the downside, you do have 520 level is well protected. That's 50-day moving average. That's close to the breakout level, 524. So this is the first level of support, 520, right? And then the next level is 510, right? We've seen this in June expiration. And here you have 530, 540, resistance number 1, 540, and then 545. 540, call 550, 3%. So you could be 3% to the upside and maybe 5% to the downside, right? All right, so that's in terms of position and high open interest. Any questions in terms of support and resistance levels? Louise, Trond, Pierre. All right, so now let's look at the Broadcom, right? We talked about Broadcom today. Let's see how people are positioning going into the Broadcom earnings. So right now, in terms of Broadcom, one is the volatility skew, right? Anything above 0.5, if you see a large concentration 0.5, that means people, this is a normal kind of a, where there is a skew to the put side, right? People are buying puts more than they're buying, buying calls, or you have people shorting calls, right? So right now, most of the concentration here, let's just confirm this, is that you have, on one side, you know, there's very high open interest around 1560, right? 1550. So 150 points, that's about 10%. So you have 10% to the upside, and in terms of on the downside, very large position, 1200. So a little bit more than 10% to the downside. So the stock could move 10% to the upside, 10% to the downside. It's pretty well hedged at 1200 level, and you do see a lot of overhead resistance at first 1500, which is 100 points, and the second one is 1550, right? So implying 150 points move. So this is based on implied volatility. Sorry, and this is based on open interest. So that means that there are a lot of people buying actually in this example, selling 1550 calls against their stock position. And there's also relatively large demand in 1200 level. And then you can look at implied volatility, right? You can look at the implied volatility. Let's go back to trade here again. Sorry. All right. So I'm looking at the Friday's expiration, right? June 14. This is when options will expire, and the earnings on Broadcom is on Thursday, I believe. AVGO. Scheduled June 12th. So schedule on June 12th. So based on that, let's look at the implied volatility. Based on supply and demand of options near the money, you can approximate the move between now and post earnings. The way you do it, you do the straddle, right? 47.60 plus $50.60. That's $100, and I'm just rounding it up. So that's at the money puts and calls. This is one standard deviation, right? So people basically saying $100, which was 1500, and we've seen high open interest at 1500, right? And if you want to do two standard deviations, then you would add all four numbers. It's a little bit less than 200, right? So 50 plus 4 times 50 is 200 minus maybe 10 points. So you have large positioning 100 points away and 200 points away based on the high open interest. And then if you look at the open interest, right, how many people are, have open position but haven't closed, right? You do see relatively large positioning at 1500, right? 1480, 1500, 684. And then the next large position was at not as much as 1600, right? So, and this is the current expiration, right? June 14, right? So you can see this position at actually negative at 1320 and large position at 1500, right? 1500. And that's this position, right? So the 30, significantly more. So implying basically that based on the one standard deviation move will probably move 100 points. Two standard deviation move, you could move to 1600. That's the second largest position, 1500, and then the next one is 1600. And you can see these spikes, basically meaning that people are buying puts and buying calls and actually financing it by selling short the puts, right? The 1320 puts. And you can see that volatility skews below 50. So it's very similar setup to what we've seen in Dell, right? We've seen Dell earnings, where if it misses earnings, you have a sharp pullback. Similar situation was in CRM, right? If they missed earnings, you have a pretty sharp pullback in CRM. And the other example would be HPQ and HPE, right? Hewlett-Packard had positive earnings, and you do have a sharp move to the upside. So based on the supply and demand of options, based on the open interest, you could see that most likely, especially if the stock has to do with AI, like Broadcom, you can expect 10 to 15% move to the upside or to the downside. Most likely it's not going to stay in the middle, right? Because of the elevated expectations. So that would be the support and resistance levels that I would expect going into the earnings, right? So about 100 to 150 points move on the Broadcom, 100 to 200 points. So how can you take advantage of that information? So let's go over call spreads, right? So one way to do this, if you're bullish on the market, right, and you trade in options, you can, well, if you have stock, I would consider maybe selling calls, just like a lot of people are doing, sell these out of the money calls. Especially when there's a high open interest, you can get a lot of premium, relatively large premium at these levels, right? Whether it's 1500 or 1550, you can sell the calls again if you own the stock. It's an expensive stock, so most people cannot afford to buy, even if it's one share, it's $1,500, so you can't really sell calls. So then if you want to participate in this trade, right, then you would have to use options. One way to do it is call spreads, right? You can do call spreads if you're bullish on the market, right? Long call spread. If you're bearish on the market, you could sell call spread, like kind of like a cover call. Or if you're bearish and you want to protect yourself, you can buy a put spread. If you're bearish and you're concerned, you can buy a put spread, or you can sell a put spread if you're bullish, right? Selling put spreads similar to buying call spreads. Selling call spreads similar to buying put spreads, right? You express your bullish or bearish bias. So let's just go over the call spread, right? The way I usually learn, how many of you trade options? Is anyone trading options? Luis, Trond, JG, Pierre, Michael, Steve, anyone trading options? So if you're trading, if you're not trading options, Luis, all right. Usually I would learn one. I would just learn calls, right? The calls is bullish bias, right? You can buy the stock at the certain price level, right? And if it goes beyond that, then you're making money. So you're buying calls when you have a bullish opinion on the market, like Broadcom, you can't really afford to spend $1,800 on one share, then you're buying call. Or if you want to reduce the cost basis, you buy a call spread, right? Because one call on Broadcom, you can see is pretty expensive, right? Even if you think that it will go, let's say, to 1600 level, right? Which is 2 standard deviation, you have to pay $3.90, right? So it's still small, maybe 20 basis points, but you have to spend $3.90, and it has to move from 1400 to 1600, which is a large open interest. The 1500 is a 1 standard deviation, which happens 70% of the time. So you can say within 70% of the time, it will either move to 1500 or 1300. If you do that, then 1 standard deviation, you have to pay $16. So again, either you buy 1 share of stock or you buy 1 contract, you would have to spend $1,600. The only way to reduce this $1,600, if at the same time you buy, right, maybe you buy 1600, but then you can sell 1600, right? And then you reduce it by $3.90. And if it's still too expensive, then you would sell 1500, right? Here you but you spend $800, which is still expensive. The stock has to move to the upside. One way to mitigate, you would do put spread and call spread. But again, it's you can see that this is expensive. What usually people can do is do butterflies, right? You can sell 2 of these calls, right? You buy 1, you sell 2, and then you're basically not spending anything, and you buy in the 1600 stock call. So this way, if you do buy one contract, sell two contracts, buy one contract, you only spend basically $3.07. So that's the cheapest way. Butterflies are the cheapest way to express your, bullish sentiment. But it's complicated. It's three-legged trades. It's a little bit more advanced. So let's just concentrate on call spread. So call spread allows you cost basis reduction, right? It allows you to spend less money to participate in trade. If you believe in AI revolution and Broadcom, is going to do better than Dell, let's say, then, or similar to NVIDIA, right? That's probably the two main semiconductors that are one of the two mains participating in AI chips. Then you would buy a call spread. Again, if you're bullish on Broadcom, then this is how you express your bullish bias. Low risk, low reward, low requirements. You give up, right? So when you do call spread, you kind of tied into the spread, right? Whatever the spread you're buying, let's say we do buy 1500 and 1550 call spread because we do see large interest at 1500. So the maximum gain is the difference between the strike prices, which is $50 minus what you paid. And in this example is $8, right? So your maximum profit is $42 times 100, right? That would be your maximum profit. But you also limited risk, right? It's the difference between the spread. You buy 16, selling 8. So you're risking $8 to make $42, but the stock has to move one standard deviation, 100 points to the upside. So you give up some of the potential, if it moves higher, right, compared to the long calls, but you also have a limited risk. So the setup is you sell an out of the money call, in this example would be 710, and you buy in the money call. In this example, when you do earnings, they're both out of the money, just one more than the other ones. If there are no earnings and you don't expect large moves, then you would buy in the money call option, right? So it just depends on situation. If you expect a lot of volatility or stocks like GameStop, right? That's been covered pretty well lately. You do see GameStop basically, you have these vertical moves to the upside, vertical moves to the downside, right? What's called gamma squeeze. Right, this is where the spreads are very important. Right? Use the same underlying asset, same contract expiration date based, on these analytics, right? Expiration months, if you plan earnings, then you're doing weekly options, right? If you buying after the earnings Broadcom, or if you want to buy NVIDIA right now that the earnings are not there anymore, then you would go use monthly options. Right now, I would go into July, right? And select strike price based on probability of success, right? We looked at the open interest, we looked at the implied volatility, and selecting strike price is the most difficult task in trading options, right? Expiration months is kind of more or less clear. 50 days till expiration. If there are no events, if there are events like earnings, you can do weekly, you can do calendar spreads. But strike price selection is more difficult. That's where the open interest is important, gamma exposure is important, and look at the implied volatility moves. So we talked about strike price selection for Broadcom. We talked about expiration months. We talked about maximum loss. Is at point A. If the maximum loss would be if Broadcom never gets to 1500, right? If it stays below 1500, then you will lose the debit that you paid for that spread, right? But you cannot lose more. If it goes outside of 1500, more than 1500, then it's the debit that you paid, right? And then you're making money. It's 0.8 plus whatever the debit you paid. So if we paid $8, then it has to move beyond 1508 for you to start making money. And then at the second strike, that's your maximum gain. So trading cost is the difference between the amount paid, right? The debit you paid between the long call and the short call, and the maximum gain is the difference in strike prices minus the debit you paid. $50 if you're doing 50 and 50 minus $1,500, $50. So that would be the difference between the strike price minus the original debit. All right. Any questions on Broadcom, how to set up these trades? On Yellow Tunnel, we do have Earnings Power Trader, right? Earnings Power Trader is where I actually trade these call spreads, put spreads, sometimes butterflies, sometimes condors. That's why I want to cover this topic, because I know some of you asked the question about the options trade, but that's Earnings Power Trader. Some people think, asking about what if I only trade stocks? We do have Aggressive Power Trader. This is every day where we have model runs and basically tells you which stocks are outperforming the market. So you have HPE, you have AMET, DHR, and then you can go into history and see every day what the stocks we're trading. And you can type in, your own stock and analyze it using our AI tool, right? You can type in Broadcom and actually see what the model thinks in terms of where Broadcom is heading, right? And you can see strong uptrend in Broadcom going to the earnings based on AI. So that's if you're interested in stock trading. So every day there are signals, and every day there's live trading room, which you can participate and watch and see how I trade these signals, or you can watch the recordings, right? So I encourage you to watch every day, watch the recordings of the live trading room so you can understand how I trade these signals. Weekly Power Trader is where this longer term signals that it takes a couple of weeks, maybe a month's holding time. Aggressive Power Trader is shorter term. Stocks like GE, Citigroup, Amazon are in strong uptrend. Dynamic Power Trader is where I trade stock and options. So you can actually go enter your phone number, and you will receive messages every time I trade, right? And you can go last 7 days and just see positions that I traded, right? I closed Amazon spread, I trimmed silver positions. So example of both stock and option trades. Right? And finally, Profit Accelerator is where I trade stocks predominantly. So we have different services, right? You can go to dashboard. I encourage you to log in, right? If you didn't get your password or you forgot your password, you can reset it at the login screen. But I encourage you to log in because you have paid services that I covered here, but you also have free services. Trend analysis, every week I create a short video giving my opinion on the market and stock of the week. And then you have a blog on Sunday. So every Wednesday you have a video blog, every Sunday you have a regular blog explaining the market conditions, key events, trends analysis. Here you can see different services. If you're interested in any of these services, I encourage you to try it out. We do give 30 days money back. Try one of these services and see if it fits your trading style and if you're learning, right? The idea is to learn, get comfortable trading stock and options, and find opportunities in the market. Any questions so far? Luis, J.G. Pieri, any questions? All right, if there are no other questions, keep an eye on interest rates, right? Interest rates, I think, is going to drive the market. Right now, we are above 50 to 100-day moving average, but below 50. So as long as there are pattern of lower highs, lower lows, I think market is going to continue to rally. But next event is CPI and PPI data, right? So if you do see a breakout above this downtrend, then market will pull back. I still think it's going to be short-lived because the consensus is that Europe started lowering interest rates, Canada is lowering interest rates. It's just a matter of time for the United States to follow. It's probably not going to happen in June, July, but it might happen September, November or December. Dollar is similar setup, right? Pierced through, it dropped to 104 level and now it's trading at 105 level, right at the 50-day moving average. We talked about technology, we talked about spiders. Let's see, what are some of the other main Materials below 50-day moving average, home builders below 50-day moving average. So you can see that certain sectors are heading higher, but certain sectors are actually going lower. Metals and miners pulled back below 50-day moving average after the unemployment data. China also pulling back right at the 50-day moving average. Industrials have been weak, they're below 50-day moving average. Transportation has been weak at 200-day moving average. And banks are sitting at the 50-day moving average. So this all indicates choppy market, higher highs, higher lows, but still expect, you know, potentially up to 5% pullbacks based on the macroeconomic data going into the July expiration. All right, any questions? All right, you guys been awesome. Thank you very much for participating. Please watch the live trading room recordings. Please participate in live trading room. Sign up for one of these services, and I hope to see you in the live trading room. Thank you very much and have a great day.